A lot of stuff's happening out there. Hello, I'm Robert Bulmer, the author of The Ultimate First Time Homebuyers Guide. A couple other books out there, Understanding the Real Estate Market, and a very important one is Understanding Simple Interest and Why All Mortgages Have to Use It. What happens when professional athletes need to get better? What happens when any professional needs to make it happen, improve? They get back to the basics. This video is getting back to the basics. What's a good way to describe it? First, let's go over my background. Listen, there's one thing I can speak to. This is the first video, so bear with me. We got to cover a bunch of stuff because I think the first video, getting back to basics, is my way of not only educating but just to get it off my chest, because I've been doing this since 1998, since I was 20 years old. And to be honest with you, as a loan consultant, I didn't even know what a home loan was when I became a loan officer or loan originator. The official terminology is loan originator. There's one thing I can speak to is home loans and owning a home and the advantages and why it is the foundational cornerstone asset. So why it's the cornerstone financial asset. Everybody loves a good conspiracy, and I follow a lot of amazing people on YouTube. And it's great. However, reality is reality. They always say, what's the saying they always say is there's a couple things certain in life, death and taxes. It's great if we didn't have income tax, but we have it. It's great if we didn't have property tax, but we have it. And until something changes, we have to play the game, utilize the financial system that we have available. It's great to wait. Oh, I'm going to wait for the big crash, without understanding the differences before '08 and now. The big factor they keep out, what caused the '08 crash. We will cover that. The big factor they leave out, it was all the predatory lending, yes, but what made it predatory? You didn't have to verify anything. We'll talk about, like in my book, the three main qualifying factors all banks look at for all loans, for all home loans. Once you understand each category, it'll make sense and the truth makes sense. It's great to wait for the market. There's the best time to buy. So we're going to go over some fundamentals. What I know to be true. First one is, and I'll put this in question form for everybody out there. What is the most valuable money in the world to somebody, to anyone, to any individual? The most valuable money in the world is someone's net monthly income. The take-home monthly income, fixed or whatnot, wherever that monthly income comes from, that's what a majority of us get to live on. I call it your blood, sweat, and tears. And that's what you get to survive, eat, pay bills, and live. And the sooner you can pay and own and pay for where you live, the sooner you will be on your way to foundational wealth. We talk about it in the book. Here's proof. The average renter, I haven't looked it up in a while, but the average renter's net wealth is anywhere from 5 to under 20 grand. The average homeowner's net wealth is well over 300,000. When you look into 80% of regular millionaires who made it, working hard and made it and invested right and did right, not only did the first major investment was the house they lived in most of the time, but 80% of all the millionaires' wealth is tied up in real estate. It is the best investment out there, historically, statistically, and really when we look at all the charts, it fulfills all the numbers. It beats and will beat any other investment. Not only that, but it fulfills so much personally. Let me tell you, when you have say where you live, it's kind of nice. So the most valuable money in the world is your net take home, your monthly income. That's the foundation of everything. And what I'm going to be breaking down in my series of videos will be even more true. It was true back in, I call it the baby boomer days, and even in it's even more true in the 21st century. Okay, another thing with our foundation, again, we can't change. We're in the debt-based financial system. We need to, as worker bees, as hard workers trying to make it, we're trying to create foundational wealth. So your net, with that in mind, your net money, what you earn and what you get to spend every month is the most valuable money in the world. Okay, second is, and again, why it becomes a foundational asset. And we will prove that. Next is, we're going to talk about, so what's the next thing? And we will get specific. So here's what I'm hearing all the time. Wait for these foreclosures to happen. Foreclosures, foreclosures, foreclosures. Well, I've been doing this since 98. I was doing it through the 08 crash, foreclosures record highs in certain areas. Some areas did just fine, held value just fine, and the areas that took a big hit came back pretty fast. But one thing, and I tell this, I'll give Obama this. I ain't going to get political on what side, because I can just tell you what I've lived and seen and what I can speak to. Before 08, and when I got in the business in 1998, you had to verify and paper trail the 3 qualifying factors in my book that we will go over, that all banks look at for all home loans, all programs. It don't matter. You need 3 out of 3. Well, that 6 to 8 years before, up to 08, they had all the programs, very similar programs that we have now, a couple extra, and the subprime market, which in the right setting helped people with lower credit. The higher rates are predatory. But we only needed 1 out of the 3. So before the 6 to 8 years during that span, I call it the Bush Jr. era, floodgates opened. Before that, you needed 3 out of 3, and you had a paper trail out of the qualifying factors. Then they said, hey, you only need 1 out of 3. Here you go. Make up everything else. And that helped build up on top of everything. That was a big factor. The '08 crash. That's what the '08 crash happens. Obama started loan modifications. Before that, man, you just got foreclosed on. You didn't have a shot. If there was a hardship, you would lose the house. '08, at least the people who wanted to stay in the home had a way to battle and keep the home and go for a home loan modification. And a lot of people were able to pull it off. And it's only been expanded on since. And even on everybody's mortgage statement and on the mortgage companies, they give you all the options if there are hardships, forbearance, loan modifications. Let me tell you something. It's very hard and expensive for a bank to foreclose on somebody if they want to keep the home. It's very, very difficult, because they have to work with the homeowner. That's why, foreclosures I love all, foreclosures and fearmonger. Don't wait for the foreclosures. But foreclosures are at record lows because the banks are working with people with hardships to keep it. We're verifying everything. Usually everybody's pretty solid because we've paper trailed and they qualify with the 3 out of 3 qualifying factors, and they're able to keep the home. An example. A young couple bought a home, got pregnant, wife had to stay home, and after even less than a year, they couldn't make the payment, went on forbearance, and got 6 to 8 months no payments, and ended up, when everything was good, the baby was born, and they were back to work, both of them. They were able to get a modification and get a much better payment and stay in the house and still build equity and be in the game with the cornerstone asset. So, and another thing, waiting for a big crash to happen. You think you're going to get all these programs that they have now? Guess the first thing that happened after '08, all the programs went away. You needed 20% down for a good year. They were restructured. It was expensive. So no more down payment assistance. Everything freezes. Another saying, the rich get richer when there's a crash, because the people who have money, they don't need to borrow money. They don't have to use the borrowed money system because they have money. Money makes money. So let's get that little fear-mongering out of the way. When's the best time to buy a house? Whenever you can pull it off. That's number 2. When's the best time to buy a house? Whenever you can pull it off. Because you start what I call the home ownership clock. You start forcing yourself to save because there is principal in that payment. And most people don't realize are in a position to pay their house off pretty fast if they paid extra. But we'll get into why home equity line of credits is the most powerful financial tool in the world. Because if we did that, the money's gone. Our net monthly income is very valuable. It's the most valuable money in the world. So we're going to talk about how to utilize, especially for current homeowners. But the best time to buy a house is whenever you can pull it off, and the best time to pull cash out or to get a financial tool, especially if you're in a position and a homeowner already, is whenever you can pull it off, especially right now. Okay, let's get into number 3. The most powerful financial tool in the world is a home equity line of credit. So let's get another myth going. Oh, I want to invest in real estate. I want to, you don't invest in real estate. Most investors who build up and invest in real estate who didn't come from money started with the house they live in. All these good programs to build a house, to do this, low down payment. All right, let's get this straight. Lesson number 1. All the programs are designed for somebody's primary residence to live in. You want to invest in real estate? You need 20% down. You need extra money reserves. Rates are higher because it's an investment property. And there are limitations depending on the program, how many loans, because people do it right. But guess what? All the people who do that started with their first house, the foundational asset, and got that home ownership clock ticking, where you start forcing yourself to save with the principal payment, and you start the appreciation clock. For savings plus appreciation equals equity, net worth. We'll get into the advanced teachings on why home equity line of credits are the most valuable financial tools in the world to anyone. Robert Kiyosaki 101, I call it. Tax-free, tax-deductible money. And one of my books, Understanding Simple Interest and Why All Mortgages Have to Use It. Another topic we're going to get into is the simple interest and understanding simple interest. So what is simple interest? Simple interest, and this is the term they call it, a simple interest loan means every month, doesn't matter what the term is. And I know that I'm not trying to sound any way, and this to me seems, but we got to give you the basics, back to the basics. All mortgages are simple interest because every single month they have to do a simple equation based on whatever the actual balance is. Here's the equation. Balance times the rate, balance multiplied by the interest rate, divided by 12 months in a year. Every month they do that equation. Coughing. Every month they do that equation. It doesn't matter if it's a 30-year term, a 5-year term, a 15, 20, 10. That's another phrase I hear. This is when you know somebody doesn't know what they're talking about. And this is with all my favorite channels out there. Oh, when you buy a house, you're paying mostly interest the first 10 years. No. Every single month, the very first month, it's the same exact simple interest equation based on the balance. And the last month, it's the simple interest equation based on the balance. Of course, the last month, the balance is lower or gone when you do that equation. But that's all they're doing. That's why when they say you can pay extra to your home loan to pay it off early, because by law, anything more than the minimum payment that month has to go to the principal balance debt and pay it down. That means the next month, that's like eliminating months to years off your term every time, depending on how much you're doing, because the next month they have to do that equation based on the lower balance. Your payment's fixed, and now your regular payment's a little more powerful because now there's a little more principal soon than it should be. And you're having that accumulation effect. And it all comes down to simple interest. And the equation they have to do every single month by law. And that is why you cannot pay a mortgage payment months in advance, because they have to do that equation every month based on the balance. It's the cheapest way to borrow money in our financial system. So we're talking about how to navigate the financial system, why the home is the cornerstone, and why the best time to buy a house is whenever you can pull it off. Understanding the simple interest. And the most value, and again, and everything in mind is the most valuable money in the world is your net take home. That's the money everybody wants. It blows my mind when we're gonna go into why that monthly net is so important. And we're also gonna go into the '08 crash. Here's something super important. A loan originator, and I'm licensed loan originator, NMLS number 322918. We have no financial interest in the rate or fees charged on a loan. The anti-steering law, first law that went into effect after the '08 crash in '09, the anti-steering law. That means a loan originator has no financial interest and cannot have any financial interest in the rate or fees charged on any home loan. What does that mean? It means we get a fixed set amount, a fixed commission, a fixed salary per loan. We can't make extra money like before and choose your rate. And here's the other part of that anti-steering law, even more important. The burden of choosing the interest rate has fallen on the borrower. We can't choose your rate. Most people still quote the old way and quote the par rate. Again, you've heard the phrase, interest rates change every day. We have to lock in that rate when we're in the right position to legally lock in. The range of available rates from the lowest to highest rate rarely shifts up or down. In fact, it's been the lowest to highest rate available for all mortgage rates has relatively stayed the same. And it's literally every single rate in between, from the lowest all the way up to the highest, every 0.1%, every 0.125. And next to every single rate, the rates themselves are not changing. That range rarely shifts up or down depending on how the Fed's meetings and stuff. So what's changing every day, and what are you locking in? Next to every single interest rate is an APR cost or rebate. So the higher the interest rate, that's where you can get rebates. Right in the middle, that's where the APR price or the discount cost, APR finance charges. If you choose the rate with the middle rate, let's say, with zero discount or zero rebate, we call that the par rate. Everything below that interest rate has a discount cost, an APR cost. That's why you're supposed to know this. When you see commercials and get advertisements and they show a low interest rate and a little higher APR next to it, that's why they have to put the higher APRs. You're supposed to know that that's a extra finance charge, a buy down. And it's those prices, those discount prices, those APR prices that get better or worse every day. And that could affect what you, the borrower, is supposed to choose. I get the same fixed set amount no matter what the rate or fees are. So we're going to get into how to use your budget right, because here's another thing that's more important that still reigned true when everything was affordable. But back in the 20th century mindset, when the baby boomers could afford everything and the money was worked better for you. And they compared, a high cost loan or buying down the rate was a couple extra grand, a few $2 to $4 grand because everything was 200,000 purchase price, not too long ago, in fact, when prices doubled overnight. But many times I've heard, it ain't worth the $50, $100, extra savings. I don't want the no cost where everything's eat up or my budget. I don't, you're able to possibly write off APR costs. And most people have their loan on average 3 or more years. That alone, you tell me, interest rate affects payment more than the cost or price. So if you use your budget to buy down and get the lower rate and have the cheaper payment, you think who pays more? Physically pays more every month, the person with the lower payment or the person who had the low no cost loan with the higher payment? The higher payment's going to always pay more. If we just took that difference in payment and talked to a financial advisor and invested that money, not only would you, after 3 years, blow that no cost loan out of the water, possibly get tax write-offs, and just invested the difference. Do you realize how much more money you'd make versus the no-cost loan? It's more important today with prices because now that can be $200 to $400 difference if you don't use your budget right. Interest rate's going to affect the payment far more than even up to $100 grand. The prices would have to drop over $100 grand to get similar payments we had when rates were at record lows after COVID. Hope I said that right, but you know what I mean. The interest rate, for example, you had an extra $20,000 for an extra to put down. I want to put extra down payment. I want a better payment. Okay, that extra 10 grand helped $50, but if we applied that to closing costs and put less down payment and got the below market rate and spent that on APR costs to get the lowest rate we could, wait a minute, I've just saved $200 to $300 extra dollars, depending on the scale. It could be even more. Your net, and again, after 3 years, the cheaper payment always blows out the no-cost loan. You get immediate benefit because it's cheaper. And your monthly payments and your monthly net income is the most important. But just pretend you didn't do it the right way and invest that difference. You will have 5 to 10 more times any cost especially after 3 years, no matter how extreme it is. And what they always leave out is the immediate benefit of the cheaper payment. You do not want to spend hundreds extra. You always want to design it to have the cheapest payment. Okay. Also, we're in a rare situation right now where buyers can get seller credits. So if you're a buyer on a budget or any buyer, first things first, seller credits maxed out before you offer a lower price. That's home buying 101, people. Home buying 101. When you're bidding or putting offers on your house, this goes for realtors and agents too, sellers, agents too, educate your sellers. You want the best prices? Be willing to help the buyers because it can get expensive and buyers are trying to make it affordable. Another point, the buyers pulling it off now are the ones who are going to be saving money and enjoying equity when rates drop. If rates really do drop, do you think the competition's going to increase with buyers? There's going to be a seller's market. Buyer's market, what that means in reality is, are you able to get any credits from the sellers to help cover your closing cost? Not only to cover what we call the hard cost, these are costs that are 99% are going to be the same no matter who does your loan. The only difference of those hard costs is what interest rate you're supposed to choose and the APR discount price for the interest rate you're choosing. That's the only thing that change. That's the only thing that can change the hard cost when you're buying a house. The regular hard costs involved, the lender fees are a small portion out of the hard cost. For example, we have underwriting and processing where I work. Acrisure Mortgage, amazing company. Again, I'm a licensed loan originator. I have a few published books out there. You're welcome to get a hold of me. I'm all over there. You're welcome to call me anytime. Please reach out. And again, you can find me on acrisure.com and you can look me up. I'm part of their mortgage division. So this is, again, we're getting back to the basics because I want to make a case that the best time to buy a house is right now. The best time to make a move is, and if you own a home, is right now. Because when you wait for a crash, the programs go bye-bye. All right, for homeowners who have the very low interest rates, who took advantage and refinanced when they were 2%, 3%, and 4%. We call that the lock-in effect. If you got the best credit and you're in the top category, you want a second mortgage, preferably a home equity line of credit, better known as a HELOC. There is no cheaper, better financial tool to borrow money in our system, our borrowed money financial debt-based system, usury system. There's no better tool than a home equity line of credit. And why is they're not going to give? There are some now. It's starting to become very popular where you can get them on investment properties. But the best one will be on your primary residence. All the best programs. Again, it starts with the first house. One house leads to another. Okay. You don't invest in homes as a regular worker bee, us hardworking people who have to survive. You don't just go and invest in homes. You start with the house, your first house, minimum down, first time home buyer, minimum down or whatever, even VA, zero down. Well, when you churn your house into a rental and go to buy another house to live in, you are getting that new house to live in pretty much the same as a first-time home buyer, with minimum down, better interest rates, no extra reserves required. The rental could possibly help qualify. And you can repeat the process. That's how you accumulate real estate, realistically. So be careful when you hear about investing in real estate, or don't buy right now because we're property taxes are gonna. I'm waiting for the crash, or I want rates to drop. That's not good. That's basically the fear-mongering, the programming to not get you to pull the trigger. Something I see a lot. Here's an example I see a lot. I see a lot of young couples with, I said renter's net worth $20,000 or less, homeowner's net worth $300,000 or less. Here's what I'm seeing a lot of, whether they're a homeowner or whether they're a renter. We got a boyfriend, girlfriend, partner. We got, because right now, back then you can have a one-person household. Now it's a two-person work household, okay, to have the same buying power. We have both working, both got similar 401ks, anywhere from 20 to 100 grand in the 401ks a piece. They got maybe, if they're lucky, 5 to 10 grand in a savings account. They got all the toys, and they got the toy payments, and they could afford it. But when you add up rent, $1,500 to $2,500, some are more. You add up car payment, another car payment, a boat, an RV, anything extra, all credit cards, minimum payments. You add it all up, most of those couples with rent and paying all their debt are putting out $5,000 to $6,000 a month to survive. They're using $5,000 to $6,000 to not get any write-offs and on all their miscellaneous debt. You know what we call that when you have all this different debt and not owning? You're paying blended accumulated interest on your debt. And everybody feels good. These couples, so that's going to weigh more than each individual rate. So when you add up, that $5,000-6,000 is doing nothing, and you're wasting your net monthly income. Feels good to have 50 to 100K in your 401. Feels good to have some stocks. It feels good. But we subtract your debt and your net worth is under 20 grand. So how much are you really worth when you're loaded with debt and you're renting? You know how many situations I call it, I've coined it, it's in my book. The debt consolidation purchase. It hasn't caught on yet, but it should. It should, because we got to get these young people out of the baby boomer mindset. Because you've done good, you've worked, you've stacked, you've saved, you got toys, you've done right, you're in your handle and you're paying for where you're surviving. But you know how many people where we can liquidate a lot, most of their assets, 401k, cash it out, take max anything, we liquidate their money, and we can put minimum down to a little more down. And instead of putting a very big, large down payment, we put the smallest down payment and use whatever we can to pay off the vehicles to do debt consolidation. The result is so powerful, it's almost too good to be true. And I don't know if it's, here we get into conspiracies, I don't know if there's a mental block or what, but when you can do a debt consolidation purchase and liquidate your assets, purchase a home. Yeah, your house might be $3 grand, even $4 grand. But when you're debt free and have no other payments, and you went from $6,000 to $4 or $3 grand, on average, it's $1,000 is actually a low savings. It's usually $2,000 to $4,000 a month. I don't think you understand forcing savings, ownership clock, forcing savings, appreciation alone. Then let's just pretend you still rent and pay $5,000 to $6,000 grand a month. Do you know how fast you'll replenish your assets and double and triple them? Because you've laid that cornerstone foundational asset. You pay and own where you live. And for the homeowners, the advanced teachings with the home equity line of credit, the top purchase clients, the hardest, best program in the world, which utilizes a HELOC for the top qualifiers. I call them the elite qualifiers. And we'll get into why a HELOC is the best second mortgage. And I've watched a video recently about how they want to use HELOCs for first mortgages. Great. It's great. Once you understand simple interest, and if you can get the right in the HELOC, again, the HELOC is adjustable rate. It has to be, because it's a 30-year term or 25, it can depend. But for the first 5 or 10 years, I like the 10-year one. The first 10 years, they call it the draw period. That's where you get to use it, AKA simple interest home credit card. But I'll tell you right now, you get a HELOC where you get a card, those aren't the good ones. The good ones are the old school ones where you get a checkbook, and that's the only way you can access it. You'll get online access for that, but the only way to access it is with a checkbook. HELOCs are great, especially, again, it goes on scale, but once you start practicing simple interest, balance times rate divided by 12, anything up to 100, 200 grand, it ain't going to matter what the interest, it's not going to matter what the rate is. It's going to be the cheapest money you have access to, period. Not even factoring in tax deductions. So we're going to get in, we will have an episode about HELOCs, the real reason, and remember it's simple interest and understanding the simple interest equation and why they have to do that balance times rate every month based on whatever the balance is that month. And a HELOC is up to a certain amount. Fixed rate mortgage, here you go. Here's one-time money. Pay me back principal and interest. HELOC, first 10 years, use it kind of like a credit card. Then mindset. All right, it's my access to my equity. But when I use it, now I look at it as a reverse home savings account. I have to aggressively pay it off with the peace of mind that I have access to it. I call it, you got to start flowing the most valuable money in the world right. That net money, we have to flow the money right, basically back into the HELOC aggressively. So when they say use a HELOC to pay off your home, it's because of simple interest. And basically, in simple terms, you're going to pay it off and put all your money back in to pay it off super aggressive. And if something happens, guess what? You can cut yourself a check. But in reality, you've been on track to pay your debt off in record time or your house off in on average 5 to 8 years. Why don't we put all our extra money into our home loan to pay it off in 5 to 8 years? Well, because we have to budget every month and survive with that net monthly most valuable money in the world. So we can't risk that and not have access to it and lose it. The HELOC solves that problem. You can be aggressive, pay it off in record time, and if something happens, cut yourself a check. You shouldn't, if you have a home and you can get a home equity line of credit, you should never have any other debt. Nothing will compare to a home equity line of credit. Okay, so I think we've covered a lot. Yeah, I think that debt consolidation purchase is, people are just scared and it feels safe to have a good amount in the 401k. But let's be real, let's subtract what you owe for your toys and vehicles and whatnot. Subtract it on your asset. If your assets are more than that, you should be shifting assets to real property, a home loan, period. And everybody who says otherwise is not telling the truth and not looking at history and the best investment in the world and the United States from history, which is real estate, real property, real assets. Again, it's going to fulfill so much personally and emotionally if you can pay and survive and own where you live. And it all starts from there. And all these baby boomers are leaving out the fact that it was the first house they bought, the foundation asset. One house leads to another. Whether you're selling it, taking the money, making moves, you're gonna have way more buying power when you own a home, especially in our system. The system everybody talks about, the system. Well, what's the system? It's debt-based, borrowed money, usury, financial, whatever you want to call it, right? Okay, back to the basics. All these programs are for primary residents. You don't invest in real estate before you own your house you live in. Not free and clear, but just you're owning it, paying a mortgage, because again, we got to start somewhere. You know, if you have good money. So really, and again, when you do have a large down payment, wow, there's a lot of cool stuff we can do, especially when we educate you about the HELOC and why it's the most powerful financial tool in the world. Crucial for self-employed, crucial for anybody. I call it Robert Kiyosaki 101. Tax-free, tax-deductible money when you use your home equity with a Dave Ramsey twist. The discipline of Dave Ramsey. Old school. If there's anything with the babe, that's the discipline I'd give. However, if you have the discipline, there's a lot better ways to structure it. I would never, ever choose a 15-year fix because I understand simple interest. And if you understand simple interest, and I'm not on either side, when Trump said 50-year mortgage, us regular people who work and want to own a home and desire to own a home should have been hell yeah. Because I understand simple interest, and if it can make it more cheaper, get me in the game, I know I'm going to start the clock. The only difference of a 50-year mortgage and a 10-year mortgage is how much principal they're making you pay on that fixed payment. The simple interest equation is exactly the same, and the interest portion is exactly the same the first month. The only difference, depending on the term, is your payment's higher because they're making you pay more principal. Therefore, the balance is lower than what it would be on a longer or versus shorter term. So if the balance is lower, that effect's going to happen faster. If I got in the game and had a 50-year mortgage to afford it, hell yeah, I understand simple interest. And everybody all freaking out on it. To me, it's like, you don't want us to own a home. You don't want us to get in the game. You hear all this. To me, I don't know what's going down out there. Maybe as we make more videos, we'll get into deeper, cool stuff and kind of go out there. But I'm going to tell you, I kind of lost track. We'll cut that out. But we'll get into other stuff, but everybody talking about and down in the 50-year, and either that's a psyop because they don't want us in the game, or they just purely don't know because we're not taught correctly. And I've talked to amazing colleagues who once they understood the concept of simple interest, you understand a HELOC. You understand why a home loan can be paid off faster. And then, of course, it'll lay the foundation, and you'll start understanding why how they talk about use a HELOC to pay off your home. All it is when you use your simple interest home credit card, you treat it, or when you owe any money on the HELOC, you could aggressively pay it down. Because guess what? The interest is dropping roughly $6-7 per thousand. So if you pay your balance down, simple saving monthly interest is the same as making it. When you keep $1,000 in your bank account, do they pay you $6 or $7? No. Do you get to write? You don't. So you have the safety and the peace of mind by aggressively paying it off and using it again safely. So that's the idea behind a home equity line of credit and how you can use it to pay your house off faster. So again, getting into everybody trying to talk everybody out. Regardless of I remember what I was going to say. Regardless of what's going to happen, conspiracy-wise, and all financial system and stuff like that. And it's true when this happens, and it's true to this day, and it was true before. What side are you going to be on? The ownership side or the renting side? Because it goes down to, are you owning or are you a renter? And it's going to be like that for everything, as we can see. But my advice to you is, whenever you can pull it off, get in the game whenever you can pull it off. So again, remember to check out my book. You're welcome to get a hold of me. We do not need personal information to game plan. I'm going to go over the 3 qualifying factors. Let's do that. We'll end with the 3 qualifying factors. Let's make everybody homeowner, mortgage, buying experts just by knowing the 3 categories. Category 1 is the easiest. Category number 2 is the most important. Category number 3 is the most difficult for most. So I'll quickly go into it. I ramble on when we're on the phone, but again, once you have this foundation and you know the 3 categories, we can pre-qualify you. Pre-qualify is verbal, going over 3 categories. Pre-approval is we have to paper trail and verify, pull credit and do that. So number 1, easiest, credit scores in your credit. Why is that the easiest? It's the easiest to get up. It's the easiest to get fixed and then stay on it. It's the easiest. So credit scores is 1 out of the 3 factors, no matter what program you're getting. Number 2, the most important, which is how much monthly income can we prove? So my question to somebody would be, do you work for somebody or are you self-employed? And then 2-year work history, because the most important one, this is where me as a mortgage professional, a loan originator with 27 years experience, is I can reverse all the equations. Once I know what our monthly income is, I can do all the equations and figure out, okay, what's the maximum you could afford? Okay, cool. What's the maximum, what's the payments and what, is it possible? So we'll break that down and what's a good way to look at it. I always teach my people is think of if you work for somebody, it's your gross monthly income before taxes. If you're self-employed, it's the net monthly income after taxes. Okay? So if you take whatever monthly income, and a good way to look at it, and this is for everybody's home, this is a training or homework or whatever you want to call it. You take your monthly income combined or solely and cut it in half, 50%. Divided by 2. Half of mind you, that's not what you're allowed to have as a house payment. This is training purposes. But we're just trying to get a baseline and coach you up. The most important is the banks are saying, hey, if you buy a house, your new house payment plus any other payments on your credit report, not utilities or food, but whatever's on your credit report, cannot be more than 50%. You can actually go a little higher, 55, but for some programs. But just for teaching purposes and learning purposes. So if you get a house payment plus other payments on credit cannot be more than 50% of your monthly income. Number 3, so 1's credit score, 2 is the most important. How much monthly income can we prove on paper? There are other programs right now, but it's alternative proving income. You can prove income untraditionally. So there are more creative programs that are back, but you still have to prove income on paper. Whether it's tax returns, W-2s, pay stubs, bank statements, there's a lot of programs to prove income. Number 3 is 2 parts. The down payment and the closing cost. Okay, right now, closing costs. Right now, one of the best advantages for buyers, because why? When we're putting offers in, we can get some good closing costs from these sellers. Sellers are a little bit more desperate, less buyers, because they're qualified out of the market because of rates. So the ones pulling it off now, they're getting that real free money to help cover cost. The down payment. There are individual programs, when it's 0 down, most of the time, it's veterans and military. They're the ones getting the VA loans 0 down. Also in rural areas, there's 0 down. They call it a USDA, but most people are putting a 3.5% down payment with FHA. Now the down payment part, there's 3 entities allowed to pay the down payment. You, the borrower, having your money saved and paper trailed. 2, a family member gifting it to you who has the money to give you and gift. 3, a down payment assistance program from the federal or state level. The seller's credits, when you cannot help with the down payment, those are the 3 entities allowed to pay the down payment. So you see all this these different programs, and you can buy a house with no money. A lot of times they're telling you we're using a down payment assistance program. There's always usually a catch. The only free money is called a grant. Those rarely come around, and they're here and gone within a month or 3 at the most, if you're lucky to even get any kind of grant. But down payment assistance, if that's how you can pull it off, that's how you pull it off. Get in the game sooner than later. Start the home ownership clock. So those are the 3 qualifying factors. Next lesson is teaching and remember I mentioned the anti-steering law, how the burden of choosing the rates falling on the borrower, how to see when the prices are and when they say rates are dropping, that means those APR discount prices are dropping. I know this is boring, but it's super important. It will change family legacy, and we got to get back to the basics. Okay, so we're going to get back to the basics. And I think a lot of youngsters, a lot of people working who's been stacking to buy a home. When's the right time? There's a lot of ways. One of these last scenarios, we do have the couples who can do the debt consolidation purchase, own and save on average $1,000 to $3,000 a month, literally from what they pay rent to their debts. And again, when we talk to the top financial advisors, we can make you a millionaire in 5 to 10 years if we can save you $1,000 to $3,000 or more a month from what you pay now renting. Those assets you have now is pennies compared to what we can do and invest with, and just pretending you still rent and pay all your toys. So that one thing. The other one is for if you've been stacking and you have a large down payment, you're debt free, when should you get in the market? We're going to structure the combination program. We're going to structure it and design your first loan, your fixed loan with the best payment, and we're going to coach you up on how to use the HELOC. So you're shifting one asset to another. You're shifting it to the equity, and then we're going to teach you where, we're not losing it on a large down payment. We actually have access to 90% of it in a home equity line of credit, and now we have access to that money. So we'll get into that as well. Again, look me up, Robert Bulmer. I'm with Acrisure Mortgage. My NMLS number is 322918. I'm an active loan originator. I have 3 books published on Amazon. You're welcome to check them out. Please get a hold of me, and we'll game plan. I'm licensed. My area, we're a nationwide company. We own the Steelers Stadium. Acrisure. My areas where I'm personally licensed in is California, Nevada, and Arizona, but I work with some amazing people that we can refer you to if you're in another state. And again, it doesn't hurt to game plan. So last thing I do is want to pull credit. Most people know number 1, your credit scores. If you know it, let's get into number 2 and 3 and figure it out and crunch numbers and game plan. No risk, open end. That's how you know you're dealing with somebody who knows what they're talking about. So this is personal experience, and the math won't lie, and the truth always makes sense. So one house leads to another. Please like, subscribe, and I will be putting out more content. Thanks.